Hi, and welcome to the second topic of corporate finance, financing decision. So in these slides, we're going through the second part of financing decisions, where we look at firstly the empirical findings, or the empirical research that try to prove the theories that we went through before in part 1. We also look at the different choices that the managers have to make when they actually go and choose different types of financing. So we continue from the last from part 1, topic 2, where we're looking at the financial inputs of the firm. So how do firms choose different types of finance here? So for week 4, our reading is chapter 13 from the textbook. So in this lecture, we're looking at firstly the empirical findings, or the empirical body of research that tried to prove the theories of capital structure that we went through before in part 1. We then look at financing from a point of view as of a marketing problem. So people try to use the different types of finance that try to maximize the image of the firm, right? Or try to be, so the type of finance should be the most appealing to outside investors, so that the investors are willing to give us a premium, right? We also look at the overall picture, so we look at different factors that the financial managers look at when they determine the company's financing decisions. So last week we looked at the theoretical studies, or the theoretical framework of analyzing the financing decisions. So with theoretical research, we start with a model, a hypothetical model, and we have assumptions, right, to simplify the model. So the theoretical research tends to be more simple, and therefore the predictions are quite straightforward. Yeah. With empirical research, the challenge is that we have to prove, the goal of empirical research is to prove a certain theory, and to do that we have to be able to control for different factors in reality, so that our empirical settings is similar to the settings in the theoretical model. So as you can see, it's a bit more challenging because the theoretical model tends to be based on a set of assumptions that might not be really realistic. Therefore, in empirical research, it's quite challenging to replicate or to try to create a situation where the theoretical assumptions are satisfied. So we'll see later on that even though for each of the theories that we went through before in topic 1, in part 1, even though the predictions of these theories are quite simple, but when we actually try to apply that into the data, we have to look at different angles of the theory, right? Because our data are not perfect. Yeah, our data is not as clean as a theoretical model. So this is the outline of the lecture. We look at firstly individual studies. So we go through the literature, the empirical literature that tries to prove the capital structure theories. We focus on 2 types of theories: the pecking order theory and the trade-off theory, the static trade-off theory. So from the body of empirical research, we'll then assess the validity of different theories. We then look at financing as a marketing problem, and finally different factors that the managers have to consider when they make a financial issuance. So as we mentioned before in part 1, in the first part of the lecture we will look at the different empirical studies the most important empirical studies in the capital structure literature. Okay. So to recap from last week, we went through a few number of theoretical models. So the first one that we started with was the M&M model, where this is when we have a perfect capital market. Right. So in the perfect capital market, the value of the financing decision is 0. Yeah, so the financing decision is not important in a perfect financial market. We then look at the trade-off theory, where we look at different benefits and costs of debt. So in terms of the benefits, we tend to focus more or less on taxes, even though the later literature also looks at different types of benefits of debt, like monitoring or reducing the free cash flows, right? But here we focus on the traditional trade-off theory, focuses more or less on taxes. We have the pecking order theory. So the pecking order theory does not try to explain a target, so it doesn't predict a target level of leverage. It tries to predict, however, the preferences of the firms when they have to issue a new type of financing. Yeah, so this is for new issuances. We also have agency theories, where they focus on the problems from having agency relationships. Yeah, so we have the agency problems between shareholders and debt holders. We also have the agency problems between managers and shareholders. So we look at first the empirical research for the trade-off theory. So the traditional trade-off theories focuses on two types of benefits and costs. So the benefits of debt comes from tax shields, right? So debt expenses or interest expenses are tax deductible. The cost, however, is the financial distress. So if we borrow too much, we have to make sure that we always have enough earnings to pay our interest payments, right? Otherwise, the lender can take us to court. Okay. So in the next few slides, we'll talk about different findings about the impact of taxes and financial distress on the leverage ratio. Yeah. So when we talk about the capital structure, it's simply just a leverage ratio. So in terms of the effect of taxes on the choice of debt or equity, so because interest expenses are tax deductible, so debt financing provides an advantage in that they reduce the total amount of taxes that the company has to pay. So if we look at the after-tax return on equity, in the classical tax system, the return on equity or return on the dividend income is taxed twice, right? So once at the company level, so TC here is the tax payable at the company level, times 1 minus TP. So TP is the personal tax, right? So the personal tax that the investor has to pay. So the after-tax income for an equity investor is the product of 1 minus TC and 1 minus TP, right? The after-tax return on that investment, however, is only 1 minus TP, right? Because we have the tax shield from interest expenses, yeah? So in theory, therefore, the amount of tax savings generated from debt financing is the difference between this amount and this amount, yeah? So this is the benefits of tax of debt financing in terms of taxes. So the prediction here is firms with more tax liabilities, they should prefer to use more debt because they get benefits, right? Meaning that there should be a positive relationship between corporate taxes and leverage. Yeah. So we mentioned before that the empirical studies are a bit more challenging. So in the theory, the model is very simple. So we start with a perfect capital market model. Then we relax one assumption at a time, right? So we allow for taxes in our model, and we model the impact of taxes on the leverage choice. Yeah. In reality, we have different factors that are in place at one point in time, right? So a company has to pay taxes. There's information asymmetry in play. There are transaction costs, issuance costs, all happening at the same time. So the challenge for empirical studies is therefore to try to control for these different factors so that our results are generated just by that one factor that we want to focus on. Yeah. So in terms of the empirical studies on the effect of taxes on the leverage choice, so because we can't observe the effective tax rates from a corporation, we have to look at different angles where we can tease out the impact of taxes on the choice of leverage. Yeah. So one strain of the literature look at the relationship between non-debt tax shields and leverage. So non-debt tax shields are items like investment tax credits or tax losses carry forward. So these items are tax exemptions or tax benefits that are not generated from debt financing. So the idea here is, if taxes are important, if firms actively try to minimize their tax payments, and because these different types of tax exemptions also give tax benefits, then they should be seen as substitutes for interest deductions. Yeah. If that's the case, if firms have a lot of non-debt tax shields, the value of the interest deductions therefore becomes smaller, right? So you can save taxes from somewhere else. Therefore, the motivation for borrowing because of tax deductions become less important. Yeah. So therefore, to prove the importance of taxes on the choice of leverage, people study the relation between the non-debt tax shields and leverage. Yeah. So this trend of literature, in general, they don't find supported results for the relation between non-debt tax shields and leverage. Yeah. For example, in this study in 1988, the authors find no relation between non-debt tax shields and the leverage ratio. Whereas in this study in 1984, people find the opposite results, right? So firms with large non-debt tax shields, they have a higher leverage ratio. We expect a negative relationship here, right? So if firm can generate tax benefits somewhere else, they should be relying less on debt. Yeah. So we expect a negative relation here. So the results from these studies tell us that either the tax deduction from debt are not important in the decision to choose different types of finance, or that our empirical studies relating to the relationship between non-debt tax shields and leverage might be noisy, right? So our conclusion here might be driven by different factors that we haven't control for. Okay. So in the previous literature, where we look at the non-debt tax shields and leverage, we mentioned that the empirical studies might be noisy because we can't really control for all the factors that affect the relation between non-debt tax shields and leverage. Yeah. So in the next few studies, people ask a different question. So how about we look at not the existing debt and taxes. How about we look at the additional taxes that firm have to pay, right? So how about we look at the marginal tax rates? Okay. So the marginal tax rate is the tax rate payable on our next additional dollar of income, right? So let's say we're standing at 2017. Our next financial year is 2018. So suppose that we anticipate that we have to pay $10,000 in taxes in the next financial year. If we were to use the financing decisions to try to minimize the tax payments, then from now until the next financial year, we would try to issue more debt, right? So in this strand of literature, people therefore look at the additional amount of taxes that people have to pay, that firms have to pay, and link that with their issuances, their financial issuances, right? So if that is important in terms of reducing taxes, then firms that anticipate a higher marginal tax rate should be issuing more debts, yeah? And this is what people find, right? So in a study in 1996, this author, so the marginal tax rate is again not observable, so we have to do some estimations to work out the expected marginal tax rate, yeah? So the author runs a simulation model, and they get an expected marginal tax rates for each of the companies in their sample. Then they use that to link it with the actual financial issuances of the firms in the next year, yeah? So what they find is that for firm with a higher marginal tax rate, they tend to issue more debts. Right. Also, when they look at the relation between the marginal tax rate and existing leverage, they actually find that the marginal tax rate also have a positive relation with leverage. So this study therefore finds supportive evidence for the impact of taxes on leverage, yeah? In addition to the marginal tax rates and non-debt tax shields, people also look at different institutional settings with different tax implications and the leverage ratio, right? So the studies that we mentioned before use US samples. And we know that in the US, there is a classical tax system where shareholders get taxed twice on their dividend income, right? In Australia, however, or in other countries like Canada or New Zealand, we have an imputation tax system, meaning that the tax payable on dividend income is actually less than the classical tax system, right? So the impact of this institutional setting is that firms in Australia or Canada or New Zealand, for these firms, the advantage of debt financing in terms of taxes is not that attractive, right? Because we start with a lower effective tax rate. So people argue therefore that if we compare a US firm and a firm operating in Australia, then we should see that the Australian firm, so if these firms have identical characteristics, right, the Australian firms, because they are operating in an imputation tax system, they should be relying less on debt, yeah? So different studies have looked at this issue, so they have compared different firms in different countries that are exposed to two different types of tax systems, and they actually find that firms in imputation tax systems, they rely less on debt, right? We also look at different tax reforms. So if suppose the government today, they decide to reduce the amount of tax payable to corporations. So if the corporate tax get reduced, then we should see a less reliance on leverage, right? Less reliance on debt financing, because the amount of taxes that the company pays is less, right? So in the literature, people also find supported results for the change in leverage after tax reform, right? So normally when you have a tax cut, the leverage of the firms also reduces. Okay. We next look at studies that look at the cost of financial distress. So we mentioned before that financial distress have direct costs as well as non-direct costs, right, or indirect costs. So the direct cost of bankruptcy or financial distress is the dollar cost that the company has to incur during the bankruptcy process. Yeah. So when people look at the economic importance of direct bankruptcy costs, they find that the actual bankruptcy cost is quite small. So the magnitude of the cost is quite small, right? For example, this study collects all the incidents of bankruptcy in the US, and they estimate the legal costs or the legal fees throughout the bankruptcy procedures that the firms have to pay. And what they find was that, so on average, the direct cost of bankruptcy is only 2.8% to 3% over the firm's total assets in the fiscal year before the bankruptcy, right? So the cost here appeared to be really minimal compared to what we would expect, right? We also have another study that look at Australian companies. So these authors, they also do similar things. They collect a sample of bankruptcies in Australia, and they estimate the dollar costs of bankruptcy. So here we're just looking at the cost throughout the bankruptcy process, right? So what they find is that the average bankruptcy cost in Australia is only 3.6% of the firm value, right? So the conclusion here is that the direct costs of bankruptcy are not that much, yeah? So it's only about, it's even less than 5% of the firm value. So in terms of the indirect financial costs, bankruptcy costs, overall the literature finds that the indirect bankruptcy costs tend to be much bigger. So what do we mean by indirect bankruptcy costs, right? So from the previous lecture, we know that these costs happen way before the firm goes into bankruptcy, right? So if the firm has a high risk of financial distress, this might cause the participants in the financial markets to stay away from the firms, right? So debt holders and shareholders, they might stay away from the firm by requiring higher risk premium, right? We also have other stakeholders like suppliers and customers, and also employees, yeah? So how do the risk of bankruptcy change the relationship between suppliers and customers or employees with the firm, right? So suppose that you sell products to a firm that has a high financial distress risk. So if the firm goes bankruptcy tomorrow, you can't recover the cost, right? Or recover the price of the products that you sell to them. From a customer's point of view, if the supplier goes bankrupt, then they have to choose a different supplier, right? So they have to search for a different supplier, and that is costly for them as well. So for these different stakeholders, the bankruptcy risk is also important, yeah? So what do people find about the effect of bankruptcy risk on these relationships? So in a study in 1988, the authors find that when the suppliers anticipate that the customers are going into bankruptcy soon, they refuse to supply products, right? Similarly, in terms of the customers, if the customer anticipate that by buying products from the supplier with high financial distress, the supplier might go into bankruptcy in the future, then they have to search for a different supplier, right? So in this case, they might refuse to buy products from the firm. Okay. So another recent study in 2008 finds support for this relation. So what they look at is they look at firms with different concentrations. So if we have a firm that has a high concentration to a supplier, this is when we have a dedicated supplier, right? Alternatively, if a firm has a very high concentration to a customer, so say 50% of the sales of the firm comes from one single customer, then this is a firm with a dedicated customer, right? So in these firms, when the firm has a dedicated customer or supplier, or when the relationship between the supplier and the firm or the customer and the firm is very important, the firm tends to stay away from that, right? So what does it say? It says that for these firms, because the bankruptcy costs for these firms can be high, given that they rely on just one or two suppliers, they don't want to borrow too much to make the customers or the suppliers unhappy, right? So we mentioned before that besides the customers and the suppliers, the firm has different other stakeholders, and financial distress can also jeopardize the different types of stakeholders. Yeah. So in these studies, people look at employees as another stakeholder. So in the study in 2010, these authors argue that financial distress hurt employees because they lose their jobs. Therefore, when employees anticipate that the employer has a high financial distress risk, they would ask for higher wages, right, to compensate for that risk. So this study predicts, therefore, that we would have a positive relation between leverage and wages, right? In 2013, another study finds support for the relation between the impact of leverage on employees, right, on expenses on employees. So what this study does is that they look at states in the US where with different employee benefits, unemployment benefits. So if a state has a higher unemployment benefit, that means that the risk of unemployment becomes smaller, right? So in these states, because the risk of unemployment becomes smaller, we expect employees to not care too much about the financing risk of the firm in these states, right? And this is what this study finds. So what they find was that in the states where the unemployment benefits are high, the companies in these days, they tend to rely more on that, right? So they have higher leverage. Okay. So overall, the expected size of indirect cost of bankruptcy is quite large. Yeah, it's about 20% compared to about 3% to 4% of the direct costs. Right. So the conclusion here is, even though the direct cost of financial distress, the dollar cost of the bankruptcy process looked small, but the actual indirect costs of bankruptcy can be much bigger, right? We then look at the impact of agency costs on the capital structure. Yeah. So we mentioned from the previous lecture that there are two main types of agency problems in the capital structure setting, right? So we have the underinvestment incentive and we have the overinvestment incentive. Yeah. So how do we set an empirical test to test the predictions of these two studies, right? So let's look at the underinvestment problem. So we mentioned before in the previous lecture that whenever we have a debt holder in place, the firm always have to make sure that they pay their debt, right? Otherwise, the debt holder can take the firm to court. So when we anticipate that we're gonna go bankrupt tomorrow, we don't want to make any new investments because the ownership of the future cash flows belong to the debt holders anyway, right? Also, if the firm borrows, they have to make sure that they always have to save a little bit of cash to pay the interest expense, right? So suppose that we have a firm with a lot of investment opportunities, so they don't have enough cash to make all the investments, right? If this firm also borrows, they also have an obligation to pay their interest expenses. Yeah. So instead of using all the cash for investments, they have to reduce the amount of cash for investment because they have to pay their interest. Yeah. Therefore, with debt financing, if we have if a firm with a lot of investment opportunities have debt, they would tend to underinvest because they don't have enough money to invest in the first place, and they also have to make sure that they have that they pay interest expenses. Yeah. So the implication here is therefore we should expect the underinvestment problem to be more severe for firms with a lot of investment opportunities. Yeah. So therefore there should be a negative relation between borrowing and growth opportunities. Yeah. Meaning that firms with a lot of growth options, they shouldn't be borrowing. Yeah. So what do we mean by growth options? How do we measure growth options? So in the literature, we normally measure the growth option using a variety or a variation of the market to book ratio. Yeah. So the market to book ratio measures the difference between the market expectation for the firm's equity value and the existing asset in place, right? So this is what the market expects the firm value to be. This is the current asset in place. So the difference here shows the expected growth rate of the firm. Yeah. So in general, people from different empirical studies, from different samples, different countries, different time periods, people tend to find a strong negative relation between growth opportunities and leverage. Yeah. Let's also look at the overinvestment problem. Yeah. So the overinvestment problem tend to be more severe for different types of firms, right? So with the underinvestment problem, the problem is that we don't have enough money to invest. Yeah. And therefore, when we borrow, the additional interest expense being an obligation further reduces the amount of cash that we have for new investment. With the overinvestment problem, this is when we don't have enough investment opportunities, yeah, but we have a lot of cash. So the problem here is because we don't have enough investment opportunities, managers then can use the funds to spend on some unnecessary investments, right? So because the problem here is when the firm has a lot of cash flows and not a lot of growth opportunities, this is more of a problem for mature firms, right? Where they have they're in a stable stage where they make profits, but they don't have any new investments to make. Yeah. So overall, we do find that for these firms, they tend to have higher leverage, which supports the idea that when you have higher debt, you have more debt, you also have higher debt obligations, and that reduces the free cash flows of the firm, right? So in the previous slides, what we did was we looked at the different types of benefits and costs of debt, being taxes, being financial distress costs, and agency issues, right? So in the next few slides, we'll look at the implications of the pecking order theory in terms of empirical studies. Yeah. So the pecking order theory predicts what? The pecking order theory predicts that there is a hierarchy of financing where the firm prefers internal finance first. So depending on the investment opportunities, the firm anticipates that they have to save how much money out of their earnings for future investments. Yeah. They then set the dividend payout policy accordingly, right? So if the firm has a lot of investment opportunities, they tend to set a low target for dividend payout because they need to use the cash, right? And vice versa. So once a firm exhausts all their internal cash flows, they then try to raise cash equivalent securities, right? So they go to the short-term markets to raise short-term funding. If they don't have any more cash or cash equivalents, they would then go into the capital markets, the long-term capital markets, to raise debt first, followed by hybrids, and finally equity, right? So once they exhaust their cash capacity and their debt capacity, only then would they rely on equity, right? So how do we set up a test? How do we set up a test setting for the pecking order theory? So what's the strategy, right? So given the data that we can observe, so the pecking order theory implies that the cost of equity is the most expensive, and therefore whenever a firm issue equity finance into the market, it always meets with negative reaction, right? So the implication of the pecking order theory is therefore that whenever a firm makes a share issuance announcement, the market reaction would be negative. In relation to debt and hybrid security issuance, the market should still be negative, but the negative reaction to debt or hybrid securities should be smaller than the reaction to share issuances, right? So in terms of the empirical studies, empirical evidence on this relation, so when people look at share market reactions to share issuances, what do they find? So they do find that share market reacts negatively to investment to a share issuance announcement. However, it seems to be depending on also the firm's investment opportunities, right? So for firms with a lot of investment opportunities, it makes sense that the company exhausts all their cash holdings. Also, they exhaust all their debt capacity, right? Because they have so much of investment needs. So the equity issuance in this case, therefore, only reflects the investment opportunities. Okay. So it makes sense in this case for firms to issue equity. On the other hand, for mature companies, these companies starts with a lot of cash flows in the first place, right? And not enough investment opportunities. Therefore, when they raise equity funding, it gives a much more negative signal to the market compared to growth firms. Yeah. Another way to look at the pecking order theory is to look at the implications of the theory on the leverage ratio, right? So the theory predicts that when the firm exhausts, the firm will always try to exhaust their cash holdings first, or their cash flows first, before they have to go into the financial markets. And when they go into the financial markets, they always try to raise debt financing first. Yeah. So the relationship between leverage or the leverage ratio, therefore, should depend on how profitable the firm is, right? So if the firm has a lot of profits, they have a lot of cash, they should not be relying on the external market that much, yeah? Meaning that if they have more profits, they should have lower leverage. Okay. So overall, there should be a negative relation between profitability and the leverage ratio. So in empirical studies, people find that there is a strong negative relation between profits and the leverage ratio, right? So that supports the pecking order theory. So the later literature also look at time series evidence for the pecking order theory. So we mentioned before that the pecking order theory doesn't have a prediction for a target, right? So the pecking order theory doesn't predict that a firm should have a 40% of leverage and it should stay forever, right? It says that the firm has a preference for different types of finance, and their leverage ratio depends on how much cash the firm has. Yeah. Therefore, the leverage ratio can vary over time depending on how much cash the firm has, or how much investment needs the firm has, right? So when people look at the pecking order theory over time, so this study in 2003, they look at the time series predictions of leverage, and they find that small firms have low leverage. This is quite puzzling from a pecking order theory's point of view, right? So if we have firms that have a lot of growth opportunities, these firms have low cash, right? Being growth firms, they should therefore have higher leverage, right? Because they likely to exhaust their internal cash holdings. Okay. But this study finds that growth companies, they tend to have low leverage. So this is contradictory to what the theory says, yeah? Also, over time, we do see that larger firms, they have higher leverage, but this declines over time, meaning that later on, in later periods, firms tend to hold more cash, yeah? So the evidence here go against the pecking order theory, right? So the evidence of the pecking order theory tends to be mixed in the literature. We also look at different other types of empirical evidence. So the challenge, as we mentioned before, the challenge with empirical tests is that we have to have a very clean empirical setting, right? So if you want to prove, for example, the Modigliani and Miller model, we have to somehow create a test environment where we have a perfect financial market, right? Similarly, for the other theories, if we want to prove the impact of taxes on the firm's leverage ratio, we have to be able to control for all other types of factors, yeah? So in reality, because the financial markets are very complex, the firm has many choices between debt and equity, and different types of debt and different types of equity. So sometimes it's very hard to correctly create a test environment where we control for all different factors. Yeah. So the later research, they try to set up an empirical strategy where they can identify at least a clear test environment, right? So in these studies, for example, people look at dual issues where companies issue both debt and equity at the same time, right? So dual issues tend to be large issues, and once they are issued, they tend to have a material impact on the capital structure. What that means is that because these are large issues and they have a material impact on the capital structure, they reflect the manager's active adjustment of capital structure, right? So this controls for the impact of outside markets or the impact of different macroeconomic factors on the capital structure. The dual issues, therefore, reflects managers' active adjustment of capital structure. So if we want to prove the trade-off theory, where the firm has a target of capital structure, this is an ideal test environment, right, where we can see management active adjustment. Okay. So this study in 2004, they find that for dual issues, for firms with dual issues, after the dual issue, they find a negative relation between growth opportunities and leverage, right? So for firms with a lot of growth opportunities, we mentioned before that the underinvestment problem is quite severe for these firms, and therefore they tend to stay away from leverage. Yeah. So this relation therefore support the trade-off theory. However, it doesn't support the pecking order theory, right? So for the pecking order theory, it predicts the opposite. Yeah. So for firms with a lot of growth opportunity, because they exhaust all their cash holdings, they should be going to the financial markets to borrow, right? So this should be a positive relation for the pecking order theory. The authors also find that there's no relation between profitability and leverage, yeah, after the dual issue, meaning that the pecking order theory is again not supported. Okay. People also look at spin-offs. So a spin-off is another case where we have a clean test environment. So spin-offs is when a company is formed when they separate from a parent company, right? So this time, because we have a new company, we can see how the capital structure is decided at the birth of the company, right? So when the company has just started, we have no historical leverage ratios. We only have the decision when the manager has to choose at this point in time what will be the optimal leverage ratio for this company, right? So in a study in 2003, when people look at the spin-off, the leverage ratio of spin-off companies, they find that for companies where they have a lot of profits and they have low cash flow volatility, so cash flow volatility relates to the firm's business risk, right? And finally, tangible assets, yeah? So for firms with a lot of profits, firms that are not risky, not too risky, and firms that have more tangible asset base, these firms tend to have higher leverage, yeah? Which makes sense, right? So if a firm has a lot of profits, it's easier for them to borrow because the interest expense would not create too much of a distress for the firm, right? For firms with not very volatile cash flows, this is when their business risk is not too high, and therefore they can afford to take on a lot of, not a lot, but some financing risk, yeah? For firms with more tangible assets, So these firms are easier to borrow because they can use the tangible assets as securities for their loans, right? They find, however, there is no motivation for using leverage to reduce tax, for these firms. So the overall picture is, even though we have some evidence against the trade-off theory, but the overall picture is that the results from here tend to support the trade-off theory, right? Okay. So we mentioned before that besides straight debt and straight equity, people can choose different types of debt, right? So the later literature also look at the different benefits and costs of debt by looking at different types of debt. So we have private debt and public debt. So if the monitoring role of the lender is important in choosing the capital structure, then we should see that lenders who are more likely to monitor would be preferred when the firm needs more monitoring, right? So if we compare a private lender and a public lender, so a private lender tends to be a bank, right? And a public lender tends to be investors from the bond market, So what are the differences between these two parties? So with a private lender, the private lenders tend to have a relationship with the borrower, so they tend to be local. They tend to have a smaller pool of borrowers, and they tend to have a direct communication with the managers, right? So if we think about banks, for example. So when we go to borrow, right, when we take a mortgage loan from a bank, we tend to talk to a loan officer. So there'll be a loan officer assigned to us, and they will be handling our case throughout, right? So with private lenders, there is a relationship between the lenders and the borrower, and therefore it's easier for the lender to get more information about the borrower, right? Whereas for bond investors, if we think about issuing bonds into the bond markets, right, we don't see our bond investors, and bond investors can change as well, right? So we might issue the bond to CBA to start with, but CBA then later on sell the issues to the secondary markets, right? So we don't have a direct communication with the bondholders, So in this case, the bond investors being more distant, they have a disadvantage in terms of generating information, right? Therefore, in terms of the monitoring role, private lenders tend to be better at monitoring compared to the distant bond investors, So in 1991, this study shows that for firms that have more for firms that are not very well governed, so these firms need more monitoring from debt holders, these firms tend to borrow from private lenders, being banks, right? Also, private debt and public debt are different in the flexibility, right, or in renegotiation ability. So this study here in 1996 introduced the concept of renegotiation ability. And they say that for private debt tends to be more flexible than public debt, especially when the firm has to renegotiate their loan terms, So suppose that we have a borrower who's not doing very well in this year, and therefore they violate one or two of the covenant violations, So when they say, for example, their earnings fall below a certain minimum level, so in this case, if the borrower fails a certain or violates a certain covenant restriction, the lender has the legal right to take the borrower to court, right? So if we think about a private lender, if the borrower believes that this is just a one-off violation, what happened is that they can go to the private lender and negotiate the loan terms, right? So they might ask the lender to extend the loan, for example, or they might ask the lender to waive that condition. Yeah. So it's relatively easy for a borrower to go and talk to one private lender and negotiate with that just one party, right? Whereas if we have a pool of bond investors, say if we have 10 investors, right, 10 bond holders, the negotiation process would be much more costly, right? So we have to contact individual borrowers and we have to make sure that all of them agree for us to extend the loan. Yeah. So because of this feature, the renegotiation ability of public debt tends to be much harder, and therefore for firms that have more volatile cash flows, for example, so firms that are more likely to violate their covenants, they tend to rely more on private lenders. Yeah. We also have a strand of literature emphasizing on the role of debt maturity. So if we think about short-term debt and long-term debt, which type of debt is better in monitoring? So with short-term debt, say if you borrow for 1 year, in the next year, you have to pay the principal, right? So today is 2017, next year 2018. If we take out a loan today for a 1 year loan, we have to pay off the principal and the interest within the next year, right? So an alternative is at the end of 1 year, we don't have to repay the whole principal. We can roll over the loan for the next year. Yeah. So with short-term debt, the advantage of short-term debt for lenders is that it allows for refinancing, meaning that after 1 year, if the firm doesn't perform very well, the lenders can require the borrower to repay the whole principal instead of allowing the borrower to refinance, right? So what that means is that if the lender is not happy after 1 year, they can take away the loan, right? So they can require payment on the loan. Whereas for a longer term loan, say if we have a 5-year loan, the principal is only paid at the end of 5 years, right? So after 1 year, suppose that the borrower behaves really badly. The lender in this case, even though they are unhappy, they can't withdraw their money, right? They can't withdraw their principal. So with long-term debt doesn't allow the lenders to voice their concerns, right, in the short term. Whereas for short-term debt, because of the repricing of the short-term debt, it allowed the lenders to voice their concern whenever the borrower has to refinance. Yeah. Therefore, the monitoring role of short-term debt is much more efficient compared to long-term debt. The implication here is that if a firm needs more monitoring, they tend to stick to short-term debt, right? Alternatively, now we know that with short-term debt, because of the refinancing feature of short-term debt, it serves as a signal, right? Because of the refinancing risk of short-term debt, only the borrowers who strongly believe that they can, that the lenders are gonna refinance their debt in the next year would choose short-term debt, right? For borrowers that anticipate that they might have problems with refinancing in the short term, they might prefer long-term debt. Yeah. So given that, it shows as a signal to the market where if the firm issues a short-term debt, it's a good news to the market, right? That's because the firm believes that they have low credit risk and therefore they're not afraid that in the future they can get refinancing. Yeah. So because of this signaling issue, short-term debt tends to be cheaper compared to long-term debt. because for long-term debt, people perceive that when the firms borrow long-term, it's a negative signal that they might have troubles in the short term, right? So they require higher risk premium in that case. Okay, so what we went through before is studies using secondary data. So we have share price data, we have historical data of share issuances, we have historical data of bankruptcies, and we use those historical data to analyze, right, to provide evidence for the studies, for the theories. We also have a different types of empirical strategy where instead of relying on secondary data, we go and ask people directly using surveys, right? So this is primary data. Okay, so when we create new data, we call it primary data, right? Whereas when we rely on historical data, these are secondary data. So the literature also focus on primary data by sending out surveys to either the directors or the shareholders and ask them about different preferences for the financing choices. Yeah. So some studies send out surveys to the CFOs or the chief financial operation officers and ask them which factors that they consider to be important when making their capital structure decisions, right? So the first study that used surveys in the finance literature is this study by Graham and Harvey in 2001, right? So to give you a bit of a background, in finance studies, we don't really use surveys too much. We don't use primary data too much. We rely on large historical data, right? Because the goal here is we try to find general patterns in the data. Okay. With survey data, even though it's more insightful, but what happens is we don't see a lot of responses, right? So for example here, this is an international studies, and they only have 313 data points, right? Similarly here, you can see that the samples for survey studies tend to be much smaller, and therefore we lose the ability of the studies to be generalized, right? So with both studies here, we're gonna see the survey later on, but both of the studies find evidence in support of the trade-off theory, right? So most of the companies have some sort of a target debt and equity ratio. So the problem here is, as we mentioned before, even though these studies are very insightful, so these are questions asked directly to CFOs, right? But the sample are very small. Therefore, it's very questionable whether these studies can be representative of the whole economy, right? So in the next few slides, we're looking at the results of the surveys, where the researchers, they go out and ask people for what are the determinants or what are the considerations when people decide the capital structure, right? So these are the different definitions in these surveys, right? So they define volatility, they define flexibility, credit rating, transaction costs for issuing debt, right? So this is more or less a study focusing on debt financing, yeah. So this is the result of the study that look at different countries, that look at the CEO's decisions in different countries. This is from the textbook, table 13.1. So this table shows the top 5 responses of the CFOs in terms of which factors are important when they decide the leverage ratio. Yeah. So flexibility comes on top for most of the companies, whereas in Australia, the most concern is the volatility of cash flows. Yeah, but flexibility is also not very far away. So from this ranking here, what do we see? We see that the most important factor to decide the leverage ratio is to maintain the flexibility of borrowing, right? So if firms don't go and exhaust their leverage capability for fear that in the future, when they have a certain need, they can't go and borrow anymore, right? Volatility comes second. So again, this goes back to the riskiness of the firm. So if the cash flows are very volatile, firms are reluctant to take on more financing risk because then the default risk would increase a lot. Yeah. The third important factor is customers and credit rating. Yeah. So credit rating ties directly to how much the market would charge on a debt issuance. Yeah. So if we look at the bond markets are dominated by investment grade borrowers. So for these borrowers from AAA rating to BB rating to BBB rating, these borrowers tend to get much cheaper interest rates in the bond market. Yeah. So credit rating again links to the riskiness of the firm, right? So the overall picture here is that we have some common theme across countries about what factors that the CFOs perceive to be important in choosing the financial decisions, right? So it appears like they do actually trade off between different benefits and costs of financing, cost of debt, and therefore this is reflective of the trade-off theory, right? Okay. So given the studies before that we discussed before, what do these studies in general suggest about the different theories that we learned from last week, right? So we go back to this trade-off, to the static trade-off theory. So the prediction here is the companies should be borrowing until the marginal tax advantage of an additional debt is exactly offset by the increase in the present value of the expected cost of financial distress. So this theory says that we should exhaust all our debt capability because of the tax benefits, right? Until the point when the risk of financial distress exactly offset the tax benefits, meaning that if we take on an additional level of debt, it doesn't help, the tax benefit doesn't increase anymore, right? So from the previous studies, the conclusion is that with the trade-off theory, we do see empirical evidence supportive of the trade-off theory in explaining different types of firms in different industries, right? So we tend to see that firms in different industries, they tend to follow more or less similar leverage ratios, right? However, the trade-off theory doesn't explain a lot of cases where firms intentionally choose a suboptimal level of debt, right? So if we think about these firms, for example, so Facebook before 2006, I think, they did not have any debt, even though they are a very safe firms. They have a lot of cash, their size is large, and they have good reputation as well, right? So Facebook at one point in time when they went through IPO, people believed that they were overvalued, right? So the markets had a very strong confidence for Facebook, meaning that when they go into the debt market to borrow, they should get a very cheap interest rate, right? But what we see is that they don't rely too much on debt. Okay, so they had a number of years where they were run as an all equity firm. before they issue their first debt issuance in 2006, I think. Okay. So the puzzle here is, why do a lot of big and stable firms with positive cash flows, why do they choose a suboptimal level of leverage, right? So this is against the trade-off theory. So one explanation here could be that, so if we look at large firms, they tend to be multinational, right? So what happens to multinational firms? So these firms, they can set up subsidiaries in countries where the tax rates are really low. And what happens is also they can transfer the profit that they make in countries with high tax rates to countries with low tax rate. And therefore, the effective tax rates that they pay is actually quite small, meaning that the tax benefits of that is not that much attractive to them, right? Okay. So in terms of the pecking order theory, with the trade-off theory, the general picture is that overall the empirical studies tend to support the trade-off theory. With the pecking order theory, it is still a very important theory, but the only support that we find in the data is the relation between profitability and leverage, right? The other evidence sort of goes against the pecking order theory, yeah? So what are the explanations for why the pecking order theory doesn't conform with the data, right? So the first criticism is that firms in high-tech industries or startup firms, they tend to borrow less, yeah? So they tend to have very low leverage ratio. And this goes against the pecking order theory, because these firms, they should have large investment needs, and therefore they should exhaust their cash holdings already, meaning that they should rely on external financing by borrowing, right? So if that's the case, then we should see that these firms having a high leverage ratio. Okay. Now the counter argument for that criticism is that because these firms have a lot of intangible assets, yeah, so they can't really use that financing in the first place anyway, because they don't have anything to use as security to borrow. So this implies that their borrowing capacity is quite small to start with. Okay, so the pecking order theory does not predict that firms always stick to debt financing, right? When they go to the outside financial markets, they only predict that the firms should exhaust all their debt capacity before they go into the equity market. Yeah. So therefore, an explanation for why we see low leverage for high-tech firms is because they have low debt capacity, right? In addition, for these firms, the cost of debt may be expensive because it's likely to induce underinvestment, yeah? Right. So as we mentioned before, high-tech firms or young firms, they tend to rely on equity markets when they raise external finance, not because they prefer equity, but because their debt capacity is quite low, given that they have intangible assets. Yeah. Okay. So we went through the empirical studies looking at the importance or the determinants of the capital structure. In the second part, we look at a different approach. So we look at the financing decision from a different point of view, right? In this case, we take a marketing approach to look at the financing decisions, where we think that the choice of a certain financial issue is basically a choice of a particular package of financial services to supply to the investors. Yeah. So if we think about the financial issue as a product that we try to sell to the investors, then what can we do? So what we want to do here is we're trying to sell the products. Yeah. So we want to make sure that the product appears very appealing to the investors, so that they are willing to pay a higher price for the product, right? So as we mentioned before, if we think about a financial issue as a product, our goal here is therefore to make the product more appealing to a certain type of investors, yeah, so that they are willing to pay a higher price, and therefore we can reduce the funding costs. Yep. So with this view, what we're trying to do is that we're trying to sell our products at a higher price than what the market is actually selling at the moment, right? So if we think about this in economics, this is when we try to identify this equilibrium where the market misprices our product. Yeah. So with this view, we're trying to capitalize on mispricing. So if we think about a manager, they try to issue. So managers, we do find empirical evidence in the literature that managers time their equity issuance, right? So they only issue equity when they think that the markets are overall are over optimistic, right? So given that in the long term, in a competitive market, the market participants, the different arbitrage opportunities tend to disappear over time, because market participants would participate in arbitrage opportunities, and therefore making the profits disappear, right? So because we're focusing on mispricing, we believe that in a competitive market, these opportunities tend to be short-lived, right? So once we exhaust all the needs of the clientele, there will be no further opportunities to sell the securities at a premium anymore, right? Okay. Alright, so to sum up, so in determining a financial strategies, as we saw before, there are different factors in place. So in the next few slides, we're looking at a summary of how these different factors can be taken into consideration, right? So we look at different factors in here. We look at business risk, we look at asset characteristics, we look at the firm's tax position, we look at borrowing capacity, right? So from the surveys before, we saw that flexibility is one of the most important factors when the firm chooses to issue debt, right? We also look at macroeconomic conditions, yeah? So with business risk, we discussed before that default risk is comprised of two components, right? Being business risk and financing risk. Okay. So if we have a firm that is exposed to a lot of business risk, or if the firm's cash flow is more volatile, then the firm should borrow less, because borrowing more increases the financing risk and therefore increases the total risk that the firm is exposed to, right? So if a firm has higher risk, when they issue securities in the external financial markets, they will be asked to pay higher risk premium. Yeah, so the cost of financing in this case would be high. Okay, so the implication of the relation between business risk and financing risk is that the capital structure decisions are also affected by the industries that the firm are operating in, right? Or the business risk of the firm. Okay. So this provides another explanation for why firms in different industries, they tend to follow different capital structures, right? Or firms in the same industry would therefore have a similar capital structure. We then look at the impact of asset characteristics on the ways that firms raise financing. We look at asset tangibility. So we mentioned before that with borrowing, the borrowing capacity is limited to how much tangible assets the borrowers can use as security, right? So for firms with more tangible assets or more fixed assets, these firms can borrow more because they have more to use as securities, right? So firms with intangible assets, what can we think of? High-tech firms, right? So with technology firms, a lot of their asset base is from innovations, from patents, and these are not tangible, right? So therefore, with these firms, their borrowing capacity is quite low. We also have asset redeployability. So we have different types of assets, right? So if a firm has a lot of company-specific assets, these tend to be harder to sell, okay? Because besides these companies, nobody else in the market uses these assets, right? So it's very hard to find buyers for these assets, meaning that if the lender have to, if the firm goes bankrupt and the lender gets ownership of these assets, it's very hard to sell company-specific assets compared to general assets, right? So therefore, the liquidation value of these assets tend to be smaller. As a result, the borrowing capacity of firms with more company-specific assets tend to also be smaller. We discussed tax positions before. So we mentioned that when the firm has a higher tax rate, the benefits of tax shields from borrowing is higher compared to firms in low tax environment, right? Like in Australia. So tax savings associated with debt, or the benefits of tax associated with debt, should be depending on how much taxes the firm has to pay in a certain countries, right? So the implication here is in Australia, where we have an imputation tax system, the tax benefits of debt is basically not that attractive anymore, right? Although it doesn't apply to non-resident shareholders. Financial slack or financial flexibility. So again, going back to the survey study that we introduced before, financial slack is the ability that the firm can go to borrow in the future. So this ability comes from the fact that the firm doesn't exhaust their borrowing capacity today, right? Okay. So because raising financing from the equity market tends to be expensive, the firms tend to maintain a borrowing capacity. So they try to borrow less than the optimal level to maintain some financial flexibility, right? So that in the future, it's easier for them to fund new investments. Okay. So this financial slack also explained why a lot of firms don't choose an optimal level of leverage, right? Okay. So in a study in 2000, this author studied Australian companies, and they find that a large proportion of Australian companies prefer to have financial slack, right? So this goes back to, so we can see from here that information asymmetry is a very, very big issue in financial markets. So going back to the graph that we saw from week 3's recap question, where we see firms' sources of funds, right? we see that firms rely a lot on cash, followed by debt, and finally equity. Yeah. So the reason why firms have to rely a lot on cash and also on financial flexibility, as we see on this slide, is because of information asymmetry, right? So information asymmetry is such a big financial friction that reduce the efficiency of financial markets. Yeah. So a point of concern here is financial flexibility. Even though it gives the firm more flexibility with future investments, but it could also induce free cash flow incentives, right, or agency incentives, because the firms have more cash in place. Okay. We also look at different other factors like the political environment and inflation. Yeah. We have political risk, where with political risk, what happens is if we invest in a very risky risky country, where it's possible that the government can take away your investment, right? So what happens here is, suppose that we have to invest in a country where sovereign risk is very high, right? So the risk of default by the government in that country is very high. It's very likely that if we invest ourselves using our money in these countries, we are going to lose our money, right? So what can we do here? If the risk of losing our money is very high, we might be discouraged from using our own equity to invest in these countries. Yeah. What we want to do is we want to borrow from local lenders in that country, so that when something goes bad, we don't lose our equity, right? So the implication of political risk in this case is that we see a lot of debt financing overseas, right? Inflation. So the effect of inflation is to increase prices in the future, right? Meaning that if we have a floating interest rate loan, it's likely that in the future the floating interest rates would increase because of the inflation, right? However, inflation affects both the interest expenses as well as our cash flows, right? So if we operate in the same economy where the inflation rates affect everyone in the economy, then the cash flows that we generate from our products, from our projects, could also offset the increase in inflation that affects the cost of borrowing, right? So these are the different factors that affect the capital structure decisions of a firm. So in this lecture, we went through from the empirical studies, looking at different factors and their impact on the leverage ratio, right? We then went through a different approach where we look at the financing decision as providing a product to investors, right? So this approach basically focuses on mispricing. Yeah. We then sum up by looking at different types of factors that might be taken into consideration when the CFO decides a certain capital structure, right? So this lecture concludes our second topic, which is the financing decision topic.